You are good to go.
Okay, thank you, Michael. Well, it's noon on Tuesday, and that means it's time for the Camel Plan Self Directed IRA 101. Those of you who are new, those of you who need a refresher, those of you who already have self directed accounts and want to learn more about what you can do with them, this is the place. I'm Joe Fulvio. I work with clients throughout the day. I am a client here, and so I'll try to answer any questions you have. Don't hesitate to put them in the chat box. Michael Duncan, our producer, is watching to make sure I don't push the wrong buttons, or smoke doesn't come out of this monitor here. So put those questions in there, and I'll do my best to answer them here. If I can't answer them here, I'll get an answer for you and get back to you via email or by phone, whichever you prefer. So we're just going to give like about another 2 seconds here just to get people who are logging on. If people don't use Zoom all the time, sometimes if I switch between Zoom and I think it's Google Meet um, and any of the other programs, and I jump on it, sometimes my settings are different. Sometimes my microphone or my headset doesn't work, so we'll just give people that courtesy to get themselves situated. Um, you might want to grab a cup of coffee. Probably just start in about 30 seconds. I hope everyone had a great Thanksgiving. Um, and this is a good time to be thinking about your self directed IRAs. If you haven't opened up a Roth, the clock begins in the year that you open it up. Um, and I can send you some information about that, but this is a good time to do that. If you have a self directed account, you'll want to be looking at getting fair market values together for your assets in your account. But we can talk about all that later. Let's get started. We're going to talk about 401 IRAs and 401ks, just the basics today. Again, if you want more information, we have a lot in our library of webinars. Michael does a great podcast series called The Road to Financial Freedom. You might want to tune into that. There are a lot of resources. First, there's a disclaimer we have to give, and this is the Legal Beagles looking out for everyone. The views expressed by speakers at our webinars those are the only speakers, but we're not having a speaker. It's members and employees. We don't guarantee the accuracy of information provided by speakers or attendees. Professional advisors should be consulted before implementing uh, any options presented. Camel Plan absolutely does not endorse or recommend any individual organization, including speakers. CAMA, its members, and employees do not accept liability for losses or damages arising from errors or omissions within, reliance upon, or any use of the information provided by speakers. Individuals are strongly encouraged by CAMA to conduct our own due diligence before making any investment choices. We do not act as nor offer the services of an investment provider, CPA, realtor, or attorney. If tax, legal, accounting, investment, or other expert assistance is required, the services of a competent professional should be sought. So, this basically explains our role as a neutral third party for you. We're going to talk about understanding what it is to be self-directed, the different types of investments you can do, how the process works, like how do you actually get the account open and get things working and do the investments, and then a bit on tax considerations and resources. And just be forewarned, I'm not an expert in that area, but again, we have people who've been doing this for 20 years here, including the founders, and they're very, very good at this. So understanding. Let's get past this slide here. Basically, a self-directed IRA is one in which you direct all the investment activities in the account. So they're the same structurally, legally speaking, as your IRA at Schwab or Fidelity or Vanguard. It's just that they're set up to allow you to invest in a much broader range of assets. It's truly self-directed. A lot of times you'll get Schwab or Fidelity or some of the other places will say, it's a self-directed IRA in the sense that you pick out the stocks and bonds and mutual funds. And that's true to an extent, but you really can't do anything in the area of alternative assets with those funds. They're not set up to do that. We are set up to do that. And so it's a nice complement. Many of our clients maintain brokerage accounts for purposes of investing in securities, listed securities, and also have an account here so that they can invest in the kind of things that you can do with only a truly self-directed account. So let's move on. Basically, this not only allows you to invest in alternative assets, but you can invest in what you know and can control versus what you might try to learn about and invest in. We get a lot of people who come to us from banking and from real estate. They were real estate agents, for example, or they were involved in real estate from the construction end of it and got into fixing and flipping. And so we get a lot of people from finance and banking, and they come to this with some area of expertise that they're able to use to direct their investments. So, if you've been in a certain industry, for example, and you think that investing in startup companies in that industry would be a good thing for you because you really know your way around, then a self-directed IRA account is a great place for you to do that. So anyway, the idea here is you invest in what you know, which should be the case for anything you invest in, even if it's on Wall Street. There's two general categories of self-directed plans. One is a tax deferred, and that is you generally get a tax deduction for funding the account, putting money into the account, but you are taxed on the proceeds and any of the withdrawals you make from that account when you're retired. Um, there is also a tax-free, which does not give you the tax benefits on the way in, but all of the earnings and all of the money in that account is tax-free. So the founder of the company, Carl Fisher, likes to compare it to paying for the seeds versus paying for the crop. In the case of the tax-free, the Roth IRA, you're paying for the seeds. The crop is all yours. In the case of the tax deferred, you're getting a break on the seeds, but you're going to be taxed on the results. So something to consider. And we have a lot of information about all these types of accounts at the website. When you go to www.camelplan.com, you can see the options, and all of these different types of accounts will be covered. There are some comparisons here between a 401k and an IRA. I mean, the biggest takeaway as someone who has IRAs, both Roth and traditional, and 401k is a 401k allows you a greater amount of contributions that you can make annually. There are certain investments that you can do inside of a solo 401k or a 401k that you can't do in a traditional or a Roth IRA. So you'll want to take a look at the differences. If you're self-employed and a contractor of some kind or a professional specialist, 401ks are a great way to stash a lot of your earnings away and make it productive. Here's where the difference between doing something inside of an IRA versus doing something outside of an IRA come into play. And we try to make this comparison. If you're making $100,000 in a given year and you're paid that as a salary or 1099, so you're being given a W-2 or you're a contractor and you're given basically $100,000. By the time federal, state, and local taxes, Social Security and Medicare, and all of that gets backed out, you end up with about 60% of that amount of money. Compare that to passive income. Let's say you invested in oil and gas, properties that produce oil and gas, or you had a piece of property, you owned a duplex, and you were generating rent. That's called passive income. And basically, under that scenario, $100,000, you would get to keep about 75,000 of it. So there's big bites being taken out of that money all the way. But when you get into IRAs and do this within an IRA, the taxes are either deferred or eliminated altogether, and you get to keep all of that money. It's a huge distinction. It's a big advantage if you're looking at an investment that gives you a 10% annualized return. That return is turbocharged when you put it inside an IRA or 401k because of the tax deferral and the tax elimination. So that's something to consider as you look at where to do your investing. Here's another way of looking at it here. It's an account comparison where you're in a taxable income scenario versus tax deferred, which is, say, a traditional IRA versus tax-free, which would be a Roth IRA. You can see the way that the accumulation, I think this assumes a 7 or a 10% gain per year over a span of 40 years. You can see how much better off you are if that money's allowed to grow in a tax-free Roth or even in a tax-deferred traditional than it is outside of these two vehicles. A lot of things you can invest in. In fact, the number of things you can't invest in is a very short list. So let's talk about some of the main categories. Real estate is huge, especially among our client base. They invest in real estate directly, meaning their IRAs own the property directly. They invest in syndicated or private placement deals, LLCs, where they own shares of property. They also do lending to people who are in the real estate business. That's the notes and mortgages. So you can lend to property developers. You can lend to fix and flip people. Private placements is just one format for investments. Private placements can include not only real estate syndications, but also private placements in small ventures and companies. So if you've got a startup company that has intellectual property and you think it's promising, and the objective of the company is to take it to market, to commercialize it and market it, that's the format or the structure for that investment will likely be private placements of some kind where you own an equity stake in that business. You can also invest in precious metals. It's gold, silver, platinum, and that is physical precious metals. Your IRA account would own them, and they would be stored in a depository. So then other is pretty much anything. We have a guy who has a dump truck in his IRA because he rents it out. He leases it to people. So people invest in coffee producers in Colombia. We have people who invest in biotech ventures. There really isn't anything we haven't seen. Within the real estate category, we see a lot of single and multifamily homes and apartments, condos, commercial property, and a lot of these are just where you'll buy the single family home with your IRA and you'll rent it out. It'll be a rental property with passive income. Other times you're part of a syndication, which is acquiring an apartment complex with the idea of rehabbing it and raising the rents, and then benefiting from that. You're either lending them the money or you're participating and you're sharing in the income from that property. Commercial property, the same thing. Helping to develop commercial property and participate in either lending to the developers or participating in the revenue generated by commercial property. There's also unimproved land. We have a webinar coming up not too long from now with someone who does land banking, and it's just a fascinating way, a take on real estate investing. There's leveraged and unleveraged properties, and without getting into too much detail, it involves some use of debt. And then foreign property investments. You're not limited to just the U.S. You can own, you can buy an office building in Hong Kong if you want. Within the lending area, there are a lot of things there. Mortgages. I've gotten involved in this before, where you become the bank and you lend to people who are who want to buy houses, and you hold the property and you hold a lien against the property, and you become just like the bank. Promissory notes made to individuals, either collateralized or unsecured. I've done this with small businesses, and that's worked out very well. You want to know who these people are because a lot of times promissory notes unsecured, there is no real recourse for you if the note goes unpaid. There are trust deeds, leases, convertible notes that convert into equity, discounted notes that you purchase with the idea of future earnings on the notes. And again, I just covered secured and unsecured. Secured is generally collateralized. It's usually real estate in the case of especially single family homes and mortgages. And then unsecured notes, where you're lending to, say, a small business to help them acquire a piece of machinery. And you don't want to get any more involved with that business than just lending them money. There's a lot of private placement activity in real estate and in just about any kind of business you can imagine. Again, we get a lot of bio stuff in here. There was a lot of crypto stuff a while back, but that's kind of taken a back seat as that thing has gone through its trials and tribulations. But the format or structure of investments, is as varied as you want to be creative. Trusts and corporations of all kinds, joint ventures, structured settlements for insurance. There are investment clubs, and becoming your own hedge fund, which, as the technologies for investing become more democratized and more available and cheaper, people are starting to do. So we're running into people who become, in essence, their own private equity firms, um, by investing in small ventures and then diversifying with other forms of investing. You can, as I said before, hold precious metals. The only thing you can't is collectibles, except for things like a U.S. The eagle and the Canadian maple leaf and the Chinese panda, and those are all allowed. But this is physical gold. It's kept in a depository on your behalf, or on behalf of your IRA. Um, yeah, despite what you hear on the radio, you can't hide it under your bed. You can't keep it in a closet somewhere. It's got to be booked. So, um, like I said, the list is very short of things you can't do, and even some of those have workarounds. Can't hold art or antiques or collectibles. Anything with a value is extremely difficult to assess. Can't hold booze in there. Don't know why you would, but um, and again, the exception is gold, eagle, silver, eagle, palladium bullion, the stuff that's produced by the U.S. government mints and by the mints of the central banks all over the world. As I said, there are some workarounds. There is a you can purchase shares in an LLC that invests in art positioned for auction. So this is a case where your investment is in the LLC that holds the art. Your investment is not in the art, and you want to seek guidance on that. Make sure your tax prep specialists and your accountants are cool with it. But yeah, um, yeah, there's a lot of rules in and around dealing with people who are close to you and dealing with yourselves. That they want to. The IRS wants to be very, very clear about that. They are disqualified persons, and you can't lease or sell or exchange property. You can't have your IRA buy a house that belongs to you. Lending money or extending credit to certain people is prohibited. It's as is providing goods and services, essentially bartering. So key things are no self-dealing and no personal use. So let's take a look at, I think there's a chart on the next slide that, yeah, here we go. So if you want to get involved and use your IRA to invest alongside of somebody or in somebody, the disqualified persons are in dark blue here. So you can't, essentially it's linear and then your spouse that you can't deal with. Your uncles and aunts, your spouse's parents, your cousins, your brothers and sisters, and nieces and nephews. You can get involved and use your IRA to invest with them and in them. I've done that in two occasions. One was my brother needed a piece of equipment. He specializes in decks, pools, spas, docks, because he lives down on the Texas Gulf Coast, and he needed a piece of equipment to pile drive um, pylons in for his docks, and we did that. It worked out because it turbocharged his ability to make money. Um, and I do the same thing with my nephew's businesses. So um, there are some limitations here in terms of your involvement, and you want to be real careful here. You can't own more than a certain amount of a company that you are going to put money into, and you can't control it, which means you can't be the a 5% owner that really controls the board of directors, and you can't own more than 50% of it. So you want to definitely pay attention to the rules there if you're investing in ventures in which you are involved at all, even as an advisor. um, so there is a page of the website that has a lot of this delineated, so you won't get yourself in trouble. But again, most competent tax professionals, people who prepare tax returns, they'll understand this stuff, and you'll want to run anything that you do, by them. All right. So we talked about what they are, what you can do, some, cautions about certain things you can't do. And so how do you get started on this? This is really could be boiled down to three steps. You open your account, you fund your account, you make your investment. And fortunately, this place is designed to help you with every step of that. The opening account process is very, very easy. It takes about 15 to 20 minutes. It's like opening a bank account. You'll provide a lot of personal information, and you'll provide information on beneficiaries, things like that. And then during that process, you'll also, if you're bringing money over from another institution where you have an IRA or a 401k, you will tee up the transfer or the rollover. So, of the three steps, opening the account, funding it, and making your investment, this process takes care of the first two. So you're really kind of jumpstart, and you're kind of on your way. Generally, people open accounts because they have an investment type in mind, or if not that, a specific investment that they want to make. And so once your funds have come over from the other institution and they're in your account, we can help you execute the purchase of that asset and coordinate with the asset provider who's providing this opportunity to you to make sure that that all goes smoothly. We say give about 2 weeks for funds to be moved from the major institutions over here. Some will do it in a matter of days. Schwab, Fidelity, Vanguard, I come to mind. Some of the others take a little bit longer. And so we say give it about 2 weeks. And once the funds are here, if you complete the asset purchase directive and all the paperwork is in order and you've signed all the documents for the investment you're purchasing, if that comes in the morning, generally that wire transfer or ACH for that investment will go out that afternoon or the following day. So then you sit back and hopefully your investment performs and you begin receiving payments. Now, investments will come in different shapes and sizes, and some will pay you regular monthly, interest in the case of lending, or a revenue share uh, arrangement. Others will balloon the payment to you over a period of time and return your principal along with your earnings at the same time. So that comes in all shapes and sizes. Um, how do we play in this? What do we do for you? As I said before, we're the neutral third party. We document everything that you do with your IRA so that the IRS has a window into it. We issue the tax documents. We record everything. We don't offer advice. We don't have any products to sell except a home for your self-directed IRA. We consider ourselves specialists in the use of these types of accounts, and we'll provide you with everything we know about that. And we have a few of the country's best experts and most experienced experts in that here. But basically, our function is to keep a record of transactions and submit appropriate documentation to the IRS, and then provide it to you so that you can file your taxes accurately. So we would work with your financial advisors, your accountants, your tax prep people. We do this all the time. So we're part of a team. We're more of a neutral third party. We're not recommending anything, but we're there to help you. I don't know if there are any. Let's see if there are any questions. And Michael, you can just dive in here and just. Can I put my patent in an IRA? Understand the case law allows for licensing to a third where I found such a country. Okay. Yeah. The short answer is yes, you can. You own the patent. You would have to have a way of valuing that patent and acquiring it by the IRA. As I said earlier, generally you can't sell a house to your IRA. The house that you own to your IRA, that's considered self-dealing. But there are some accommodations for intellectual properties. Again, the key there, Al, is getting an appropriate valuation that the IRS is going to accept, and so that there's a fair market valuation of that asset when it's acquired by the self-directed IRA, and there may be some limitations over paying you for it. So you may be able to invest in the patent with your IRA instead of putting the patent in your IRA. So if, say, you have intellectual property and you form an LLC and you go after your patents and all of that is part of your either your LLC or your C corp or whatever structure you pick, the IRA could invest in that, provided again you don't own more than 50% of that entity or don't control it. So I can provide some experts that can give you some additional advice on that. But it's a real interesting area, and it's you have to be kind of careful. So. Um, All right. And I think that was the only one from Al, but and Al, if you want and you want to give Michael your contact information, and I think we'll have it because you're registered, we'll find you. And let me get some clarification on that for you. So I'm just skipping over it like a stone across thrown across a lake. There's a lot you can do and that you shouldn't do in that area. Timeline, typically I covered that. Basically, we say give it 2 weeks from the time that you open your account and request a transfer or initiate a rollover at your other financial institution and the time your funds arrive. And once the funds arrive, then you're able to do your investing. You can fund the IRA account by moving other IRA money over. Same goes for 401ks. There are some rules there. 401ks generally get transferred into IRAs or they get rolled over into IRAs. But rather than getting all of that, getting into all of that, it's basically you're transferring money, you're rolling over money, or you're contributing money. So transferring and rolling over, again, it's about 2 weeks. Contributions you can do instantly. Once you have your account open, you go online, you select contribution, you tell us what you want to put in there and where it's coming from, and we'll pull it. And there are contribution limits, so you want to pay attention to those, and also contribution limits that are influenced or guided by your income level. So we have a page of the website there too. If you go to resources at camelplan.com and you look at contribution limits, you get an idea of that there. How to invest in an asset through a self-directed account. You'll find the asset. Let's say you have your account set up, you have your money there, and you find an asset that you want to invest in, and let's not get into whether it's real estate or private placement or what form it is. You'll do your due diligence. That's probably the biggest thing, the biggest step you have to take when you're doing something like this, because you're really in the driver's seat here, and it's up to you to find out if the people you're dealing with are reputable, if the asset actually exists, if the property that they're selling you is actually, if they actually own it. We've had instances where there were the implied that contracts had been signed with certain people promising certain volumes of business, and you get behind it, you find out those contracts didn't exist. So you really need to do your due diligence on that. And we have some people that, again, I'm thinking of Mark Halpern. He gives due diligence courses here, and he's available through the website under our references section, and he's really good with this. But you'll definitely want to do not only due diligence, but get it in front of your advisors. Make sure you know what you're doing. Who signs the paperwork? Okay, you're going to make the commitment or on behalf of your IRA. So you, John Smith, or Al Young will not sign the paper as Al Young. You will sign it as Camel Plan for the benefit of Al Young's IRA. So you will be the one who's directing your IRA to do the investment. The IRA will actually do the investment. Can you use yes, you can. You can use your IRA for a down payment on a property you want to own. You're not going to own. No, you can't do it if you want to own it personally. You can do it if you want to own it in your IRA, but you can't do that. No, because that's lending to yourself and that's self-dealing. So can I receive a loan to purchase property? Yes, you can, as long as it's a non-recourse loan. And again, we have a lot of resources on non-recourse loans and how you can do that. Can I manage the property? This question comes up all the time with people who want to buy real estate, rental properties, particularly vacation properties. And the rule is you can't touch it. You can invest in it, but your IRA operates that property like a business. Carl has a saying, you can pick out the color of the paint, but you got to hire a painter to do it. So you can't. You'll hire a property management company to collect the rents. You'll have gardeners and people who do maintenance work, and you'll pay all of those people out of your IRA. You pay the taxes out of your IRA. It's a hands-off. You're just operating the rental property as a business. What do I do if there's a capital call? We see these occasionally. Your asset provider, the person who sold you that investment, will contact you and contact us. Let us know what you need. That's basically purchasing more of an asset that you're already invested in. So it's making a purchase. You can do it pretty quickly through your through the portal when you log in. So that's typically the kind of stuff that we get asked all the time. Al, that was a great question. I'm already thinking of what we could do with that, but we'll get you some more. We'll get you some more on that later. I'm not going to get into this too deeply. It's situations where their ownership in a business that's not taxed as a C corporation. The long and short of it is you're investing in a passive income type of investment, and it generates other forms of income. And when you share in that other form of income, you might get hit with unrelated business tax. This is another due diligence question. It's a real good one to ask anyone who's peddling an investment opportunity for you is how does unrelated business tax, UBIT, or and in cases where you're financing an investment with debt, the unrelated debt finance income. So these are two specialized areas. Again, I'm not trying to make this sound too daunting for you. Yeah, everybody gets past these, but it is something you want to look at. There's a bunch of IRS publications at our website that are published by the IRS. So you're getting it from the horse's mouth. Again, the numbers probably don't mean anything to anyone who isn't already steeped in this stuff. So I'm just going to leave this slide right where it is. That's about it from the, for the standard presentation or the standard overview. Will is my colleague. You can feel free to contact him at the numbers. And I'm going to leave these up on the screen. And then feel free to contact him or call and ask for Joe. And they'll put you through to me, and I'll do whatever I can to help you get started in this. If you're already into it, and you have questions, don't hesitate to call, because you need to be making the most out of what you've got. As I said, we have upcoming workshops and webinars. You'll want to take a look at the calendar section at the website. It has a list of everything we've got out into the future. We have a huge library of webinar recordings. They cover a lot of different aspects of self-direction and delve pretty deeply into the different types of assets that people invest in here. There is a real estate investment page for those of you who are interested in that specific asset. And again, I'm going to urge you to check out the our podcast, Michael Duncan's podcast, which is The Road to Financial Freedom. And it's wherever you listen, you'll be able to find it. If you're on Spotify or you're on iTunes, you just plug into the search, The Road to Financial Freedom, and it'll pop up. Go ahead and subscribe to it, listen to it for a while, and make sure, you give us some feedback on it, especially when it comes to things like, topics you'd like to see, because, we never get enough feedback from everybody on that. I think that's it. And I think everybody's probably delayed their lunch for this who are listening. So I want to thank you for your time. Al, thank you for your question. I'm going to look at that question and pass it off to Carl and a few other people here and just get some more background on it so that, you have something to share with your financial advisor and your tax prep specialist. That's it. Thanks again for everybody. And Michael, I guess you can sign me off whenever. Everyone have a good day.